January 2025 is starting with the United States and the European Union implementing a comprehensive ban on Russian oil imports, marking a significant escalation in their economic sanctions against Russia. This decisive action aimed to curtail the financial resources fueling Russia's ongoing military activities, particularly its involvement in Ukraine. The sanctions targeted various facets of Russia's energy sector, including major oil companies, shipping vessels, and associated infrastructure. The origins of these sanctions trace back to Russia's annexation of Crimea in 2014 and its subsequent military interventions in Ukraine. Over the years, the international community, led by the USA and EU, imposed a series of economic measures to deter Russia's aggressive actions. However, by 2025, it became evident that previous sanctions were insufficient in compelling Russia to cease its military operations. Consequently, a more stringent approach was adopted, focusing directly on Russia's lucrative oil industry, which constitutes a substantial portion of its national revenue. The 2025 sanctions encompassed several critical components designed to disrupt Russia's oil export capabilities. One, prohibition of oil imports. Both the USA and EU ceased all imports of Russian crude oil and petroleum products. This move aimed to diminish Russia's export earnings and reduce its influence in global energy markets. 2, targeting major oil corporations. Sanctions were imposed on prominent Russian oil companies, including Gazprom Neft and Surgutneftegas. These measures restricted their ability to engage in international transactions, access foreign capital, and procure essential technologies for oil exploration and production. 3, shipping and transportation restrictions. The sanctions extended to nearly 200 oil-carrying vessels, many of which were part of a shadow fleet that previously evaded sanctions. By targeting these ships, the USA and EU sought to impede Russia's capacity to transport oil to alternative markets. 4, financial sector measures. Financial institutions facilitating transactions for Russian oil exports faced stringent restrictions. This included freezing assets, prohibiting dollar and euro transactions, and limiting access to international banking systems. The immediate aftermath of the sanctions saw a notable impact on global oil markets. Oil prices experienced volatility due to the sudden reduction in supply from one of the world's largest producers. For instance, U.S. crude prices surged by 4% to nearly $77 per barrel, while Brent crude, the global benchmark, rose by 3.7% to approximately $80 per barrel. To mitigate potential supply shortages, the USA increased its domestic oil production, achieving record-breaking outputs. This strategic move aimed to stabilize global oil prices and ensure energy security for allied nations. In response to the sanctions, Russia sought alternative markets and methods to sustain its oil revenue. Efforts include diversifying export destinations to non-Western countries, notably China and India, offering discounted prices to attract these markets, utilizing alternative shipping routes, and financial countermeasures. The comprehensive ban elicited varied reactions on the global stage. Allied nations largely supported the sanctions, viewing them as necessary to uphold international law and deter aggression. Conversely, countries with strong economic ties to Russia expressed concerns over energy security and economic repercussions. Diplomatic efforts intensified, with international bodies facilitating dialogues between Russia and Ukraine to resolve the conflict. The sanctions were intended not as punitive measures, but as leverage to encourage a peaceful resolution and adherence to international norms. These sanctions are not just another round of economic restrictions. They were designed to cripple Russia's energy sector and, by extension, its economy. For Russia, the oil industry is the lifeblood of its financial system, accounting for around 40% of the country's revenue. The loss of access to Western markets, capital, and technology set in motion a series of ripple effects that would reshape Russia's oil industry and global energy markets. Before the sanctions, Russian oil was a major player in the global energy market. Countries in Europe and Asia relied on Russia for a substantial portion of their oil imports. With the US and EU halting Russian oil imports, Russia was left with fewer places to sell its crude. This sudden loss of market access caused an immediate drop in oil revenues, which had been vital for the Russian government's ability to fund its military operations and maintain domestic stability. The ban on oil imports was not just a blow to Russia's oil companies, but also to the state's budget. The Russian government relies on oil revenues to fund social programs, pay pensions, and support other public services. The loss of this income put the government in a precarious position. In response, Russia began seeking new buyers for its oil, particularly in Asia. The sanctions didn't just impact Russia's ability to sell oil, they also disrupted its ability to produce and transport it. One of the key factors that enabled Russia to be a major oil exporter was its access to advanced technology and machinery. Western companies had been providing Russia with equipment and expertise for decades, helping it extract oil from challenging regions like the Arctic and deep offshore fields. The sanctions put an end to this support, forcing Russia to either rely on outdated technology or find new suppliers. But without the necessary expertise and modern technology, Russia's oil production has started to decline. Major fields that had been yielding large quantities of oil began to see slower production rates, and some oil extraction projects were delayed or even canceled. This reduction in output meant that Russia was not only losing revenue from oil sales, but also facing increased costs to maintain its production. Moreover, Russia's export capabilities were significantly hampered. The US and EU sanctions targeted Russian shipping companies, preventing them from using Western ports and insurance services. Russia had relied on a fleet of oil tankers to transport its crude to markets around the world. With sanctions limiting its access to Western ships and insurance, Russia's oil exports were restricted, and alternative routes were not always as efficient or reliable. The rise of the shadow fleet. In response to the sanctions, Russia began to rely on a shadow fleet, a network of tankers and vessels that were not registered under Russian flags and often operated under the radar. These ships are used to transport oil to countries that are still willing to buy Russian crude, such as China, India, and other parts of Asia. However, this solution comes with its own set of problems. First, the shadow fleet isn't as efficient or secure as the Western-controlled fleet. These ships often lack the advanced technology that Western tankers had, leading to delays and increased costs. Additionally, the ships operate in a legal gray area, meaning they are subject to frequent inspections and scrutiny from international regulators. This makes it harder for Russia to maintain a consistent supply of oil to its new buyers. Second, these tankers face increasing pressure from the US and EU, which seek to shut down this workaround. The US imposed sanctions on any company or nation that was found to be involved in the trade of Russian oil, including those using the shadow fleet. While these measures didn't immediately stop the flow of oil, they created a sense of uncertainty and instability in the shipping industry, further increasing the costs and risks for Russia. Financial and banking strain. Another significant impact of the sanctions is on Russia's financial system. The sanctions targeted major Russian banks and financial institutions, preventing them from accessing international financial markets. This makes it difficult for Russian oil companies to obtain financing for new projects or even maintain existing ones. Without access to Western capital, Russia's oil companies have to rely on domestic funding or loans from countries like China, which are willing to support Russia in exchange for oil. However, this comes at a cost. The terms of these loans are often less favorable, with higher interest rates and stricter conditions. Additionally, the lack of access to international financial markets makes it harder for Russian companies to raise the capital needed to maintain or expand their operations. The sanctions also affected Russia's ability to process payments for its oil exports. The US and EU targets Russian financial institutions that are involved in processing transactions for oil sales, further complicating Russia's ability to collect payments for its crude. This forces Russia to seek alternative methods of payment, such as using the Chinese yuan or other currencies. But these alternatives are not as widely accepted or as reliable as the US dollar or the euro. Shifting geopolitical alliances. With its oil industry under siege, Russia is forced to shift its geopolitical alliances in an attempt to mitigate the effects of the sanctions. Russia turned to countries like China, India, and Turkey, which are more willing to continue buying Russian oil despite the international sanctions. In exchange for oil, Russia offered these countries favorable pricing and long-term contracts. China, in particular, emerged as one of Russia's most important oil buyers. As Russia sought to expand its oil exports to Asia, it entered into a series of agreements with China to build pipelines and establish joint ventures in the energy sector. This allowed Russia to continue selling oil, albeit at a lower price, and helped mitigate some of the revenue losses caused by the sanctions. Long-term outlook for Russia's energy sector. The sanctions imposed in 2025 are likely to have a lasting impact on Russia's energy sector. In the short term, Russia will continue to face challenges in maintaining its oil production and export levels. The country will need to find new ways to overcome the technological and financial hurdles created by the sanctions. In the long term, however, Russia's oil industry may undergo significant changes. The country's reliance on oil as its primary source of revenue could decline as it diversifies its economy and seeks to invest in other sectors. The sanctions may also spur Russia to invest in renewable energy technologies as it looks for ways to reduce its dependence on fossil fuels. The sanctions may also prompt global changes in the oil market. As Russia seeks new markets for its oil, it could reshape global trade routes and force other countries to adjust their energy strategies. While the sanctions have caused significant disruption, they have also created opportunities for countries like China and India to expand their influence in the global energy market. Global oil prices and the ripple effect of Russian sanctions. In the immediate aftermath of the sanctions, the global oil market experienced a significant spike in prices. The reduction in Russian oil supply led to a sudden shortage of crude oil, particularly in Europe and parts of Asia, which had relied heavily on Russian exports. This disruption caused panic buying and a scramble to secure alternative supplies, driving up prices worldwide. For example, the price of Brent crude, the global benchmark for oil prices, soared to over $150 per barrel in the first few weeks following the sanctions. This was a sharp increase from the $70 to $80 per barrel range that had been common in the years leading up to the sanctions. The rise in oil prices led to higher gasoline and diesel costs, which directly impacted consumers. Countries that depended on affordable fuel for transportation, such as in Europe, saw their energy bills rise dramatically. The higher prices also led to inflationary pressures, as goods and services became more expensive due to the increased cost of transportation and production. For countries like the United States, where oil prices are closely linked to the cost of gasoline, the surge in prices sparked public outcry and political debates about energy independence and the role of foreign oil in the economy. The shift to alternative oil suppliers. One of the immediate responses was an increase in imports from other major oil-producing countries, such as Saudi Arabia, the United States, and Canada. These countries, which had the capacity to ramp up production, became key players in filling the gap left by Russian oil. However, the shift was not without challenges. While these countries could increase production to some extent, they are limited by existing infrastructure, environmental concerns, and geopolitical considerations. For example, Saudi Arabia, the world's largest oil exporter, increased its production but was also cautious about oversaturating the market as it wanted to maintain price stability. The United States, with its booming shale oil industry, saw an increase in exports, but the infrastructure to export this oil is limited, particularly when it comes to shipping it overseas. Moreover, some countries, such as China and India, turned to Russia's oil even after the sanctions were imposed. Russia offers steep discounts to its oil buyers in Asia, making its oil an attractive option for countries that were less concerned with the political ramifications of buying Russian oil. These deals are seen as a way for Russia to maintain its oil revenue despite the sanctions, and they further complicated the global oil market. While Europe and the United States largely avoid Russian oil, other countries, particularly in the global south, continue to import it, undermining the sanctions' effectiveness. The long-term impact on oil prices and energy security. Over time, oil prices will most likely stabilize, but they most likely will remain higher than they had been before the sanctions. The loss of Russian oil creates a new dynamic in the global market, with supply chains becoming more fragmented and less predictable. Countries that had relied on Russian oil are forced to adapt, either by securing alternative suppliers or by increasing domestic production. At the same time, the sanctions prompted many countries to seek greater energy independence. In the United States, for example, the Biden administration has accelerated its efforts to increase domestic oil production, particularly from shale oil fields. The U.S. government is also exploring ways to increase the country's reliance on renewable energy as oil prices remained volatile and the need for energy security became more apparent. The oil trade, once dominated by Western countries and companies, begins to shift as Russia finds new partners. The geopolitical realignment in the oil market reflects broader shifts in global power dynamics as countries like China, India, and Russia increasingly position themselves as rivals to the West. This shift has implications not only for the oil market, but also for global politics, as energy becomes a key battleground in the ongoing struggle for influence. Furthermore, the sanctions have prompted countries to reconsider the role of oil in its foreign policy. The United States, for example, used its control over global financial systems to impose sanctions on Russian oil, demonstrating the power of economic measures in the modern geopolitical landscape. Similarly, the European Union, which had been heavily dependent on Russian energy, found itself reevaluating its energy relationships and looking for ways to reduce its reliance on Russian oil and gas. As countries continue to navigate the challenges of a changing energy landscape, the role of oil in global power dynamics will remain a critical factor. The sanctions on Russian oil have demonstrated the complex and interconnected nature of the global energy market, and the effects of these sanctions will likely continue to be felt for years to come. In the end, the 2025 sanctions may serve as a turning point in the evolution of the global oil market, with lasting consequences for energy security, international relations, and the future of oil prices. The shift to renewable energy, a response to Russian oil sanctions. The sanctions placed on Russian oil have created a dramatic shift in the global energy landscape. With oil prices spiking and energy security becoming a top priority for many nations, governments and companies around the world have increasingly turned their attention to renewable energy as a solution to the instability caused by these sanctions. The sudden disruption of Russian oil supplies, once a stable and cheap energy source for many countries, has made it clear that the world needs to rethink its reliance on fossil fuels and invest more in cleaner, sustainable alternatives. At the heart of the response to the sanctions on Russian oil was a sudden urgency to find reliable and sustainable sources of energy. The abrupt spike in oil prices following the sanctions created a wave of panic among consumers, businesses, and governments. In the immediate aftermath, many countries that had relied heavily on Russian oil found themselves scrambling for alternatives, which led to an increased interest in renewable energy solutions. One of the most significant changes was seen in Europe. Countries like Germany, Italy, and France, which had previously imported large quantities of Russian oil and gas, realized that their energy dependence on Russia had put them in a vulnerable position. With the sanctions in place, these nations are faced with skyrocketing energy prices and a growing need to diversify their energy sources. In response, many European countries have accelerated their transition to renewable energy. For instance, Germany, which had long been one of Russia's largest energy customers, fast-tracked its investments in wind and solar energy. The government is committed to expanding the use of renewable energy sources to reduce the nation's dependence on fossil fuels. This move is not only driven by the immediate need for alternative energy, but also by a growing awareness of the environmental and economic benefits of clean energy. In addition to government initiatives, businesses and individuals have also begun to invest more heavily in renewable energy. The rising cost of oil made solar panels, wind turbines, and electric vehicles more attractive than ever before. People were increasingly looking for ways to insulate themselves from the volatility of the global oil market and take control of their energy needs. In some cases, companies have begun transitioning their fleets to electric vehicles, while others explored the potential of biofuels and other renewable energy sources. Renewables gaining traction. Solar and wind energy have long been considered the frontrunners in the push for renewable energy. These two sources of power have been seen as viable alternatives to fossil fuels due to their abundance and sustainability. In the wake of the Russian oil sanctions, both solar and wind power experienced significant growth, particularly in countries that had previously been heavily reliant on oil imports. Solar energy, in particular, saw a surge in investment and adoption. With oil prices rising sharply, governments and businesses looked for ways to reduce their exposure to fossil fuel price fluctuations. Solar panels became an increasingly attractive option for homeowners and businesses alike. In many countries, subsidies and tax incentives were introduced to encourage the installation of solar panels, making them more affordable and accessible to the general public. Similarly, wind power experienced a boost in both offshore and onshore wind farms. The European Union, in particular, invested heavily in expanding its wind energy infrastructure. The UK, for example, committed to building a large number of offshore wind farms to reduce its reliance on fossil fuels. These projects not only help to meet the growing energy demand, but also create jobs and stimulate local economies. As wind power became more cost-competitive with traditional fossil fuels, many countries see it as a key part of their long-term energy strategy. The increased focus on solar and wind energy also helps to push down the cost of these technologies. As more countries invest in renewable energy infrastructure, economies of scale have begun to make solar and wind power more affordable. This helps to make renewable energy a more competitive option for consumers, businesses, and governments alike. The role of electric vehicles and energy storage. In addition to renewable power generation, the transition to electric vehicles, EVs, has also gained momentum in the wake of the Russian oil sanctions. With the price of gasoline and diesel skyrocketing, many consumers turn to EVs as a more cost-effective and environmentally friendly alternative. The growing popularity of EVs was driven by both the desire to reduce fuel costs and the increasing availability of affordable EV models. In response to the surge in demand for electric vehicles, automakers around the world ramped up their production of EVs. Companies like Tesla, Volkswagen, and General Motors increased their efforts to develop and release new electric models. At the same time, governments introduced incentives and subsidies to encourage consumers to make the switch to electric vehicles. These measures included tax breaks, rebates, and reduced registration fees for EV owners. Alongside the rise of electric vehicles, energy storage technologies also gained traction. The shift to renewable energy sources like solar and wind brought with it the challenge of ensuring a consistent energy supply. Since solar and wind power are intermittent, meaning they don't generate electricity all the time, energy storage solutions became increasingly important. Batteries and other storage technologies were developed to store excess energy generated during sunny or windy days, ensuring that energy could be used when needed. Energy storage solutions also help to address the issue of grid reliability. In countries that are heavily investing in renewable energy, there is a growing need to modernize the electrical grid to accommodate the new sources of power. Smart grids, which can adjust energy distribution in real time based on supply and demand, becomes a key part of the energy transition. The global push for green hydrogen. While solar, wind, and electric vehicles are at the forefront of the renewable energy revolution, another emerging technology, green hydrogen, begins to gain attention as a potential solution to the world's energy needs. Green hydrogen is produced using renewable energy sources like wind or solar power to electrolyze water, splitting it into hydrogen and oxygen. The hydrogen produced in this way is considered green because it doesn't involve any carbon emissions. Green hydrogen has the potential to play a significant role in decarbonizing industries that are difficult to electrify, such as heavy manufacturing, shipping, and aviation. For example, hydrogen fuel cells could be used to power large trucks or ships, reducing the reliance on diesel and other fossil fuels. Many countries, including Germany and Japan, have already started investing in green hydrogen technology, recognizing its potential to contribute to a sustainable and low-carbon future. The rise of green hydrogen is also tied to the global push for energy independence. As countries look to reduce their dependence on fossil fuels, green hydrogen offers a promising alternative. It can be produced locally using renewable energy, which makes it a more secure and sustainable energy source compared to oil and natural gas, which are often imported from politically unstable regions. The long-term benefits of renewable energy. The sanctions on Russian oil in 2025 acted as a wake-up call for many nations, highlighting the vulnerabilities of relying on fossil fuels for energy. As a result, the global transition to renewable energy has accelerated, with countries investing heavily in solar, wind, electric vehicles, and energy storage. This shift has the potential to bring about significant long-term benefits. First, renewable energy is much cleaner than fossil fuels, which will help to combat climate change and reduce greenhouse gas emissions. By investing in renewables, countries can reduce their carbon footprints and move closer to meeting their climate goals. This is especially important in light of the growing environmental concerns surrounding fossil fuel consumption. Second, renewable energy is more sustainable in the long run. Unlike oil and gas, which are finite resources, renewable energy sources like wind and solar are virtually limitless. This means that countries can secure a more reliable and stable energy supply, reducing their exposure to the volatility of global oil markets. Finally, the transition to renewable energy can stimulate economic growth. The renewable energy sector has created millions of jobs worldwide, from manufacturing solar panels to constructing wind farms. As more countries invest in renewable infrastructure, these industries are expected to grow, providing new opportunities for workers and businesses alike. The 2025 comprehensive ban on Russian oil imports by the USA and EU represents a pivotal moment in the application of economic sanctions as a tool of foreign policy. By directly targeting the cornerstone of Russia's economy, these measures aim to compel a strategic recalibration of its international conduct. The long-term efficacy of the sanctions, though, depends on sustained international cooperation, effective enforcement, and Russia's willingness to engage in constructive dialogue to address the underlying causes of the conflict. That's it for today. Thanks for watching to the end. Kindly like and share, and don't forget to subscribe for more updates.